So every single day in the crypto markets, millions of dollars are just transferred directly from the pockets of beginners right into the wallets of seasoned professionals.
Yeah, it really is a constant transfer.
And the crazy part about this wealth transfer is that, the pros aren't using some secret billion-dollar algorithms to pull it off. They're literally just waiting patiently for beginners to make the exact same psychological mistakes over and over again.
Right. I mean, it is essentially a market that monetizes human nature. The environment never sleeps. It's incredibly volatile, and it just ruthlessly punishes impatience.
Definitely.
So if you bring your natural, unchecked emotional instincts into the crypto market, you are going to pay a very steep tuition.
Which is exactly why we are pulling apart today's source material. For you listening, we are taking a deep dive into a really concise but remarkably heavy-hitting guide titled Crypto Trading for Beginners. Avoid these 7 mistakes.
It's a fantastic guide.
And the premise is what caught my attention immediately. It argues that beginners don't usually fail because crypto is mathematically impossible to trade. They fail because they sabotage themselves before the math even has a chance to play out.
Exactly. The focus here isn't on, hunting for a magic technical indicator or some complex trading strategy.
Right, no magic bullets.
Right. The guide is incredibly grounded. It asserts that simply protecting your capital and building a repeatable, disciplined process will elevate your trading far faster than trying to outsmart the market.
Okay, let's unpack this.
Okay.
Because if the goal is discipline, it makes sense that the guide zeroes in on the most fundamental failure a beginner can make, which is stepping into the market without a concrete plan.
Yeah, absolutely.
The text insists that before you even think about clicking buy, you need 3 exact numbers written down. Your entry price, your profit target, and your stop loss, which is the exact price where you admit you are wrong and sell to prevent further damage. Trading without these rules is like going on a cross-country road trip without a map, a fuel gauge, or a spare tire.
That's a great way to put it. Those 3 numbers represent your entire architectural blueprint. Without them, you aren't participating in trading, you are participating in gambling.
But I have to push back a little on the rigid stop-loss rule here. Crypto is notoriously volatile.
Oh, definitely.
So if a beginner sets a strict stop-loss, won't they just get wicked out?
Yeah.
Where the price drops for a split second, triggers their automatic sale at a loss, and then instantly shoots right back up to where it was. Because that seems incredibly frustrating.
It is. That is a very real frustration, but it happens when a beginner places a stop loss arbitrarily.
Arbitrarily? How so?
Like, they might buy a coin at $100 and just say, well, I'll set my stop loss at $95 because I only want to lose 5%.
Right, based on their own feelings.
Exactly. But the market doesn't care about your arbitrary 5% tolerance. A strategic stop loss has to be placed below structural support. So, a price level where historical data shows buyers naturally step in.
Oh, I see.
Yeah, if you get stopped out below support, it means the structure of the market has fundamentally changed. And, you want to be out of that trade anyway.
That distinction makes a lot of sense. You aren't picking a number based on how much pain you can tolerate.
Mm-hmm.
You're picking a number based on where the market actually proves your underlying theory wrong.
Exactly.
But, why is it so hard for beginners to just write down a simple plan? The text notes this is a major hurdle.
What's fascinating here is that writing down a plan creates an undeniable record of accountability.
Right.
If you just keep the numbers floating in your head, the parameters remain fuzzy. So when the price inevitably starts dropping, your brain immediately starts negotiating.
Oh, I was planning to hold it a bit longer anyway.
Exactly. Or it's a long-term investment now.
Yeah, you just move the goalposts so you don't have to admit you missed the kick.
Precisely. But if you have it written down on a sticky note on your monitor like, I will exit at $95, and you don't do it, you have to look at that physical evidence of your own lack of discipline.
Ouch. Yeah, that's tough.
Human beings genuinely hate being proven wrong. We will go to extreme lengths to avoid situations that force us to confront our own errors. So keeping the plan vague is really just an unconscious defense mechanism.
And that psychological fragility feeds right into the next major mistake, which is risking too much of your account on a single idea. The text says beginners frequently throw 50 or 60% of their capital at one trade because they're convinced it's a sure thing.
Yeah, and the guide argues you should be risking a tiny fraction of that, usually just 1 or 2% of your total account value per trade.
Wait, why so small? If you only risk 2%, you are never going to see those life-changing gains that bring people into crypto in the first place, right?
Well, because the primary objective of a beginner is not to get rich quick. The primary objective is to survive long enough to figure out how the game is actually played.
Survival.
Yeah, let's look at the math. If you risk 50% of your account on a bad trade, you have decimated your capital and your psychological confidence. It takes a 100% gain just to get back to where you started.
Wow, right. And chasing a 100% gain usually leads to even riskier behavior.
Exactly. But if you risk 2% and the trade goes against you, it's merely data. You paid a tiny tuition fee to learn what doesn't work.
That's a great way to reframe it.
Right. You could be wrong 20 times in a row and still have 60% of your capital left to trade tomorrow. Keeping risk small is about ensuring one bad trade doesn't ruin your ability to continue trading.
Okay, so let's say a beginner actually writes down their plan. They have their entry, they have a smart stop loss placed below structural support, and they're only risking 2%.
A solid foundation.
The foundation is set, but then the market opens. And this brings us to the psychological traps of action. The guide points out that beginners routinely abandon their pristine, written plans the moment they see a coin's price skyrocketing on the chart.
Oh yeah, the fear of missing out. FOMO.
Here's where it gets really interesting, because the guide is very explicit about this.
Yeah.
It warns that buying after a coin has already surged is a massive trap. It advises waiting for a pullback to enter.
Right.
But from a beginner's perspective, if a coin is surging upward, isn't that proof that it's a good trade? Like, why does jumping on the train while it's moving trap people?
To understand that, you have to look at the mechanical reality of an order book. You know, for every single transaction, there must be a buyer and a seller.
Right, basic economics.
So when you see a massive green candle on a chart indicating a huge price surge, you are seeing the result of early buyers. The smart money, or maybe just the lucky money, bought in days or weeks ago.
Right, so they are sitting on massive profits on paper.
Exactly, on paper, but to convert those paper profits into actual spendable cash, they have to sell their coins.
Oh, I see where this is going.
And to sell a large volume of coins without crashing the price, they need a sudden influx of eager, euphoric buyers willing to take those coins off their hands at the highest possible price.
Wait, so when I see that massive green spike and I finally hit buy because I can't take the SOMO anymore, I'm literally just handing my cash to the person who bought yesterday so they can exit.
You are becoming their exit liquidity.
Wow.
Yeah, you are buying the top just as the early adopters are stepping away from the table. And once that buying pressure from FOMO dries up, the price violently crashes back down.
That's brutal.
That is why the guide insists you wait for a pullback. You want to enter the market when the hype has exhausted itself. You know, the impatient people have sold and the price has found a stable floor.
So you're basically showing up to a party after everyone has already left, and you are the one stuck paying the cleanup bill.
That's a perfect analogy.
That concept of exit liquidity completely reframes how a green chart looks. And I imagine realizing you just became someone else's exit liquidity causes a lot of emotional damage, which leads directly to the next mistake, overtrading.
Yes, exactly. What the industry calls revenge trading.
Right. The guide touches on this, noting that trading more frequently does not correlate with more profits. When someone takes a painful loss, their ego is bruised.
It is.
The immediate human reaction is this desperate desire to win that money back right now, to prove the loss was just a fluke.
So they immediately jump into another trade, usually abandoning their checklist and taking a lower quality setup just to get back into the action.
Right, trying to force a win.
But the market is completely agnostic to your emotional state. It doesn't know you just lost money, and it certainly isn't going to give you an easy win to make you feel better.
And the other side of overtrading is simply the illusion of productivity, right? Crypto is open 24 hours a day, 7 days a week. It's so easy to feel like if you aren't holding a position, you are wasting time.
Which is a fundamental misunderstanding of the job. A trader's job is not to trade constantly. A trader's job is to protect capital and wait for high probability setups.
Right.
Sometimes the best trade is doing nothing at all. The most profitable action you can take for your portfolio in a given week might be to sit on your hands.
Doing nothing is an active strategic choice.
Oh.
Okay, so we've addressed the internal psychological hurdles, the resistance to planning, FOMO, and revenge trading. Let's transition to how we interpret the external data the market gives us.
Okay.
Because even with a calm mind, looking at a crypto chart can be completely overwhelming. The guide addresses two major mistakes here, which are ignoring the Bitcoin trend and relying on too many indicators.
This is where we move into the actual mechanics of reading the market environment.
The source is emphatic about this rule. Before you trade any smaller cryptocurrency, altcoin, you must check if Bitcoin is trending up, down, or sideways.
Yes, absolutely crucial.
It claims that trading an altcoin against the broader trend of Bitcoin drastically reduces your chances of success. But why does Bitcoin have that much authority over a completely separate coin?
If we connect this to the bigger picture, think of Bitcoin as a massive cargo ship navigating a narrow canal, and all the thousands of altcoins are just little dinghies tied to its hull.
Okay, I'm picturing that.
Bitcoin holds the vast majority of the capital in the entire cryptocurrency market. Furthermore, algorithmic trading bots are highly tuned to Bitcoin's price movements, and most altcoins are literally paired with Bitcoin on the exchanges.
So their values are mathematically tethered.
Precisely. So if that massive cargo ship suddenly throws its engines in reverse, the sheer water displacement is going to drag all those dinghies backward.
Right, of course.
It doesn't matter how hard the captain of a little dinghy is trying to row forward, right? The macroeconomic current created by Bitcoin is too strong. Trying to trade an altcoin upwards while Bitcoin is crashing is financially dangerous.
You always check the direction of the cargo ship first. That makes perfect sense. But once a beginner establishes that Bitcoin is trending in their favor, they pull up a chart for their specific coin and run into the next trap. They load their screen with every technical indicator they can find.
Yes, the dreaded cluttered chart.
Looking at a chart with 20 indicators is like trying to drive a car with a dashboard that has 50 flashing warning lights. It's just paralyzing. The guide advises extreme simplicity. Use one trend indicator, like a moving average, one momentum indicator, like an RSI, and rely primarily on basic price action.
Beginners often assume that if one indicator gives them an edge, 10 indicators will give them a massive advantage.
Right, more data is better.
But indicators are essentially just mathematical formulas reacting to past price data. They are tools for confirmation. They are not crystal balls.
For those who might not be familiar with the jargon, a moving average just smooths out the choppy price movements to show you the general direction over time, right?
Yes, exactly.
And what exactly is an RSI? A relative strength index. How does that measure momentum?
Think of the price of an asset like a rubber band. The RSI measures how fast and how far that rubber band is being stretched. If the price shoots up incredibly fast, the RSI will indicate the asset is overbought, meaning the rubber band is stretched to its absolute limit and is highly likely to snap back.
Makes sense.
And if the price drops aggressively, it becomes oversold, suggesting a bounce might happen.
So if you just have a moving average to show the trend and an RSI to tell you if the rubber band is about to snap, why not add 5 more tools to be safe?
Because eventually they start contradicting each other. One momentum indicator says buy, a volume indicator says sell, a trend line says wait. It creates total analysis paralysis.
It's like trying to navigate a forest using a GPS, a magnetic compass, a sextant, and a paper map all at the same time. Eventually, slight variations are going to have them pointing in 4 different directions, and you just end up standing still confused.
Exactly. The text emphasizes that indicators should only be used to confirm what the actual price is doing. Price action is king. Strip the chart down.
Keep the chart clean. Understand the macroeconomic trend. So what does this all mean? We now have a plan, we understand our own psychological pitfalls, and we have a clean chart. The final hurdle the guide discusses is live execution.
Right. When the trade is actually live.
The real money is on the line.
Yeah.
How do you hold the plan together?
This is the crucible. This is where the difference between theory and practice is exposed.
The guide states that letting emotions control an active trade is the ultimate mistake. Fear, greed, and frustration are what ultimately cause you to break the rules you established when you were calm.
Yep.
And the most striking piece of advice it offers to combat this is a strict prohibition. You must never move your stop loss farther away to avoid taking a loss.
Let's walk through the psychology of that moment.
Yeah.
You bought an asset at $10. You set a strategic stop loss at $8. The market drops, and the price is now at $8.10.
Yeah.
It is creeping dangerously close to closing your position for a loss. The beginner panics. They think, oh, this is just a temporary dip. If I just move my stop loss down to $6, it will give the coin room to breathe and recover.
They are actively choosing to increase their total risk exposure right in the middle of a losing trade.
Yes. They're substituting strategy with hope. And hope is a disastrous mechanism in financial markets.
Right, because hope isn't a strategy.
Exactly. You calculated that original $8 stop loss when your mind was clear, objective, and unemotional. When the price is crashing and is flooded with adrenaline and fear. You have to trust the objective analysis of your past self over the panicked desperation of your present self.
Which leads to what I think is the most profound mindset shift in this entire text. The guide argues that you must judge yourself by whether you followed your plan, not by the financial outcome of a single trade.
Right.
If losing money is part of trading, how does real success change a beginner's daily experience?
It forces you to understand probabilities. In normal life, if you lose money, it means you made a mistake. You bought a faulty product or you dropped your wallet.
Yeah, it's a negative thing.
But in trading, you can execute your plan flawlessly, do everything right, and still lose money on a specific trade because the market is probabilistic, not deterministic.
So if your stop loss triggers, and you take a $50 loss exactly where you planned to.
That is a highly successful trade.
Really?
Yes,
Yeah.
Your strategy worked, your discipline held. You prevented a $50 loss from turning into a $500 loss. Taking a planned loss is a victory for your process.
A planned loss is a victory. That fundamentally rewires how you look at a red number on your screen.
It has to.
And to anchor that discipline, the guide provides an ultimate tool, a 7-step pre-trade checklist. You are supposed to run through this logically before every single execution.
It perfectly synthesizes everything we've discussed. Let's look at the mechanics of it.
Step 1. Is Bitcoin trending up, down, or sideways? We know why that matters now. You check the cargo ship. Steps 2 and 3. Where is the nearest support? And where is the nearest resistance?
Support is the floor, the historical price where buyers stepped in to push the price up. Resistance is the ceiling, where sellers historically stepped in to take profits, pushing the price down. You have to map the room before you walk into it.
Steps 4, 5, and 6. What is my entry, my stop loss, and my target? We know these must be written down.
Yeah.
But it's step 7 that seems to tie the entire mathematical reality together.
This raises an important question, doesn't it?
It does. Step 7 asks, is the potential reward actually worth the risk?
That final question is the ultimate gatekeeper of your portfolio. You could execute the first 6 steps perfectly, but if your analysis shows that your profit target will make you $20 and your stop loss requires you to risk $50, the math is fundamentally broken.
It's a negative risk to reward ratio.
Exactly. Even if you are a fantastic trader and you win 60% of your trades, a negative ratio will eventually bankrupt you over time. Conversely, if you strictly take trades where you risk $20 to make $60, so a 1 to 3 ratio, you can literally be wrong the majority of the time. You could lose 6 out of 10 trades, and you would still be profitable overall. Question 7 forces you to evaluate the math objectively before the emotion hits.
It forces you to operate like a casino, rather than the gambler walking through the doors. The casino doesn't win every hand, but they know the mathematical edge is in their favor over 1,000 hands.
Precisely.
As we wrap up this deep dive, the source material leaves us with a specific, actionable homework assignment. And for you listening right now, taking 10 minutes to do this will crystallize everything we've talked about.
Moving from theory to practice is the only way to build the muscle memory.
The assignment is to open up the chart of a recent trade you made, or even just hypothetical one you were watching. Look at it honestly and identify which of these traps you fell into.
Ask yourself, which of the 7 mistakes have you made the most?
Did you become someone's exit liquidity? Did you ignore the Bitcoin trend? Did you move a stop loss? Figure out what specific rule from today could have prevented it, and commit to using that 7-question checklist before your very next trade.
Honest self-reflection is the only true edge a retail trader has. And looking comprehensively at all of this, rigid checklists, the risk parameters, the deep psychological traps we naturally fall into, it leaves me with a lingering thought that wasn't explicitly stated in the guide, but echoes through all its lessons.
What's the thought?
If the ultimate secret to surviving and thriving in financial markets is the rigid suppression of our most natural, deeply ingrained human emotions, like the fear of missing out or the hope of recovery, does mastering the crypto market require us to train ourselves to act more like cold, calculating machines? Or, ironically, does the market simply force us to become far more profoundly self-aware humans?
Are we programming ourselves to act like algorithms? Or are we just finally holding up a mirror to our own psychological flaws? That is a fascinating, heavy concept to chew on. Thank you so much for joining us on this deep dive. Take that checklist, write your numbers down, and we will see you next time.